When a solid foundation cracks, it rarely happens all at once. The pressure builds quietly, out of sight, until the structural integrity finally gives way. This daily chart shows the reality of today's price action. We can see the definitive close right here at 23,996, meaning the Nifty 50 has officially slipped beneath the critical psychological level of 24,000. Right now, thousands of retail traders are staring at their screens, feeling that immediate spike of anxiety as they look at their open positions. The question for tomorrow is binary. Is this a temporary engineered discount meant to be bought, or the leading edge of a much deeper structural correction? Guessing the answer based on gut feeling or hope in this specific zone is a fast track to account ruin. The natural retail instinct is to blindly buy a red day, assuming they're getting a bargain. But that ignores where institutional capital is actually deploying. To see past the sentiment, we rely on participant-wise open interest. This data allows us to see how institutional players are actually allocating capital, regardless of what the market noise suggests. By synthesizing raw chart patterns with this data, we stop trying to guess tomorrow's opening bell and start identifying the specific levels where major supply and demand are already being positioned. In this breakdown, we will calculate the high probability zones for both a gap up and a gap down, giving you the hard support and resistance triggers you need for either scenario. Surviving the massive volatility of the first 15 minutes of the trading day requires an objective, pre-built blueprint. Let's start by looking at the sentiment of the retail crowd, labeled in the data as clients. This participant data table reveals exactly how retail is positioned. Look right here at the Client Future Index long row. Retail traders have leveraged themselves into a net positive position of 64,583 contracts, anticipating a bounce. Now we pivot to the opposite force moving the market, foreign institutional investors, or smart money. This table details FII positioning. In the Future Index short row, FIIs hold a net negative 22,857 contracts, aggressively betting against a recovery. Moving down to options data, FIIs are overwhelmingly net short on option index calls, holding over 78,000 contracts against upward momentum. When billions in institutional capital are deployed directly counter to retail sentiment, it creates a textbook trap environment. Attempting to go long tomorrow means actively fighting the deepest pockets in the financial system. That creates an asymmetric, highly unfavorable risk profile for buyers. We can map exactly where the battle lines are drawn by looking at the specific strike prices in the option chain. This chart visualizes current open interest. Notice the massive spike at the 24,000 level. That towering red bar represents 19.15 crore in call open interest, creating a massive barrier of overhead supply. For every tick upward, the market must absorb millions in institutional selling. Compare that to the relatively weak, scattered put open interest structures sitting below the current price. If early buyers push the market up into that 24,000 liquidity pool, those call riders will defend their premiums by dumping aggressive sell orders straight into the tape. The 24,000 mark has shifted from a reliable support pad into a hardened institutional resistance wall. Moving away from the derivative tables, the raw price action confirms this downward momentum. This 1-hour chart highlights short-term market structure. On the right, a clear pattern of lower highs and lower lows dragged the index down to the 23,991 close. This recent drop clearly breaks below the previous consolidation zones established throughout July. Buying here simply because the price hit a historical support line is the definition of catching a falling knife. We do not have a new structural trend change. Because technical momentum aligns with the heavy FII short positioning, the bias for tomorrow remains bearish. The high probability scenario tomorrow is a gap down or flat open. The immediate downside target is 23,800, where early riders cluster. If 23,800 fails, the next major structural floor waits at 23,500. This specific environment is ideal for trend-following short sellers looking to capitalize on existing downward pressure. Avoid all bottom fishing. Do not attempt a long trade until a distinct 15-minute bullish reversal pattern prints exactly at those support levels. A gap down simply confirms the institutional data, providing clear path of least resistance downward setups. If global cues force an artificial gap up, we run our contingency plan. Any upward push slams into that severe resistance at 24,000. Even if broken, the secondary resistance cap sits rigidly at 24,200. That makes a gap up a high probability sell on rise opportunity. The data suggests that any early pop will be aggressively sold into. This bearish bias only gets canceled if the Nifty can sustain a price above 24,250 for over an hour. That specific event would force FIIs to start covering their shorts. Entering the morning with a data-backed blueprint for both directions replaces guesswork with objective triggers. It protects your capital and aligns your trades with the demonstrated action